The mutual fund industry is now the world's largest skimming operation, a $7 trillion trough from which fund managers, brokers, and other insiders are steadily siphoning off an excessive slice of the nation's household, college, and retirement savings. Senator Peter Fitzgerald. Insult to injury. Nothing is more infuriating than to be told one price, but then realize that you are paying another. You agree on the price of a new car, but when it comes down to signing the documents, a couple thousand in fees magically appear. Or you check out of a hotel and discover an additional resort fee, a tourism tax, a wireless internet fee, fees for towels. You get the point. It's frustrating. We feel trapped. We feel snowed. Strong-armed or simply deceived into paying more than we should. With the help of fine print, the $13 trillion mutual fund industry is hands down the most masterful in the craft of hiding fees. In a Forbes article entitled The Real Cost of Owning a Mutual Fund, Ty Bernick peels back the layers to dissect the actual cost and arrives at a heart-stopping total. The average cost of owning a mutual fund is 3.17% per year. If 3.17% doesn't sound like a big number to you, think of it in light of what we just learned about becoming or owning the market. For example, you can own the entire market, let's say all 500 stocks in the S&P 500, for as little as 0.14%, or as the investment world calls it, 14 basis points, BPS. That's just 14 cents for every $100 you invest. Just a quick FYI for you insiders, there are 100 basis points in 1%, so 50 basis points is 0.5% and so on. Owning the entire market is accomplished through a low-cost index fund such as those offered through Vanguard or Dimensional Fund Advisors. And we already know that owning the market beats 96% of all the mutual fund stock pickers over a sustained period. Sure, you might be willing to pay 3% to an extraordinary hedge fund manager like Ray Dalio, who has a 21% annualized return, before fees, since launching his fund. But with most mutual funds, we are paying nearly 30 times, or 3,000% more in fees, and for what? Inferior performance. Can you imagine paying 30 times more for the same type of car your neighbor owns, and it goes only 25 miles per hour to boot? This is exactly what is happening today. Two neighbors are both invested in the market, but one is shelling out fistfuls of cash each year, while the other is paying pennies on the dollar. Same returns, different results. The cost of ignorance. Three childhood friends, Jason, Matthew, and Taylor, at age 35, all have $100,000 to invest. Each selects a different mutual fund, and all three are lucky enough to have equal performance in the market of 7% annually. At age 65, they get together to compare account balances. On deeper inspection, they realize that the fees they have been paying are drastically different from one another. They are paying annual fees of 1%, 2%, and 3% respectively. Below is the impact of fees on their ending account balance. Jason, $100,000 growing at 7%, minus 3% in annual fees, equals $324,340. Matthew, $100,000 growing at 7%, minus 2% in annual fees, equals $432,194, and Taylor, $100,000 growing at 7%, minus 1% in annual fees, equals $574,349. Same investment amount, same returns, and Taylor has nearly twice as much money as her friend Jason. Which horse do you bet on? The one with the 100-pound jockey or the 300-pound jockey? Just 1% here, 1% there. Doesn't sound like much, but compounded over time, it could be the difference between your money lasting your entire life or surviving on government or family assistance. It's the difference between teeth-clenching anxiety about your bills or peace of mind to live as you wish and enjoy life. Practically, it can often mean working a full decade longer before you can have the freedom to quit working if you choose to. As Jack Bogle has shown us, by paying excessive fees, you are giving up 50% to 70% of your future nest egg. Now, the example above is hypothetical, so let's get a bit more real. Between January 1, 2000, and December 31, 2012, the S&P 500 was flat. No returns. This period includes what is often called the lost decade because most people made no progress, but still endured massive volatility with the run-up through 2007, the free fall in 2008, and the bull market run that began in 2009. So let's say you had your life savings of $100,000 invested. And if you simply owned or mimicked the market during this 12-year period, your account was flat and your fees were minimal. But if you paid the 3.1% in average annual fees, and assuming your mutual fund manager could even match the market, you would have paid over $30,000 in fees. So your account was down 40%, only $60,000 left, but the market was flat. You put up the capital, you took all the risk, and they made money no matter what happened. I am smarter than that. Now, you might be reading along and thinking, Tony, I am smarter than that. I looked at the expense ratio of my mutual funds, and it's only 1%. Heck, I even have some no-load mutual funds. Well, I have some swampland in Florida to sell you. In all seriousness, this is the exact conclusion they want you to arrive at. Like the sleight-of-hand magician, the mutual fund companies use the oldest trick in the book, misdirection. They want us to focus on the wrong object while they subtly remove our watch. The expense ratio is the sticker price most commonly reported in the marketing materials. But it certainly doesn't tell the whole story. And let me be the first to confess that at one stage in my life, I thought I was investing intelligently, and I own my share of the top 5-star actively managed mutual funds. I had done my homework. Looked at the expense ratios. Consulted a broker. But like you, I am busy making a living and taking care of my family. I didn't have the time to sit down and read 50 pages of disclosures. The laundry list of fees is shrouded within the fine print. It takes a PhD in economics to figure it out. PhD in fees. Just after the 2008 crash, Robert Hilton Smith graduated with a PhD in economics and decided to take a job with policy think tank Demos. And like all of us, nothing he learned in college would prepare him for how to create a successful investment strategy. So, like most, he started making dutiful contributions to his 401k. But even though the market was rising, his account would rarely rise with it. He knew something was wrong, so he decided to take it on as a research project for work. First, he started by reading the 50-plus page prospectus of each of the 20 funds he invested in. Incredibly boring and dry legalese designed to be, in Hilton Smith's words, very opaque. 5. There was language he couldn't decipher, acronyms he hadn't a clue what they stood for, and, most importantly, a catalog of 17 different fees that were being charged. There were also additional costs that weren't direct fees per se, but were passed on to and paid for by the investors nonetheless. To better shroud the fees, Wall Street and the vast majority of 401k plan providers have come up with some pretty diverse and confusing terminology. Asset management fees, 12b1 fees/marketing fees, trading costs, brokerage commissions, spread costs, market impact costs, soft dollar costs, redemption fees, account fees, purchase fees, record-keeping fees, plan administrative fees, and on and on. Call them what you want. They all cost you money. They all pull you backward down the mountain. After a solid month of research, Hilton Smith came to the conclusion that there wasn't a chance in hell that his 401k account would flourish with these excessive and hidden fees acting as a hole in his boat. In his report, titled The Retirement Savings Drain, The Hidden and Excessive Costs of 401ks, he calculated that the average worker will lose $154,794 to 401k fees over his lifetime, based on annual income of approximately $30,000 per year, and saving 5% of his income each year. A higher-income worker, making approximately $90,000 per year, will lose upward of $277,000 in fees in his/her lifetime. Hilton Smith and Demos have done a great social good in exposing the tyranny of compounding costs. Death by 1,000 cuts. In ancient China, death by 1,000 cuts was the cruelest form of torture because of how long the process took to kill the victim. Today the victim is the American investor, and the proverbial blade is the excessive fees that slowly but surely bleed the investor dry. David Swenson is the Chief Investment Officer of Yale's endowment. He has grown the fund from $1 billion to more than $23.9 billion, and he is considered to be the Warren Buffett of institutional investing. When I sat down with him in his Yale office, I was enlightened yet angered when he shared the real truth regarding the fee factories that are slaughtering Americans. David shared, overwhelmingly, mutual funds extract enormous sums from investors in exchange for providing a shocking disservice. Later in the book, we will sit down and look over David's shoulder at his portfolio recommendations, but it doesn't matter how great your strategy is if excessive fees are eroding the path beneath your feet. The asset-gathering complex and the actively managed mutual funds they peddle are, for the most part, a disastrous social experiment that began with the advent of the 401k in the early 80s. The 401k was not a bad concept. It was a good idea for those who wanted to put extra money away. But it was just meant to be a supplement to a traditional pension plan. Today there is over $13 trillion in managed mutual funds, much of which is held in retirement accounts such as 401ks and IRAs. They were supposed to get us to our retirement goals. They were supposed to beat the market. But not only do they rarely beat the market, a significant majority are charging astronomical fees for their mediocrity. The aggregate of these fees will ultimately cost tens of millions of people their quality of life, and could very well be the #1 danger and destroyer of your financial freedom. Sound like an overstatement? Jack Bogle, founder of Vanguard, says, "I think high costs, eroding already lower returns, are as much of a risk for investors as the economic situation in Europe or China. It gets worse. So let's recap. Not only will the vast majority, 96%, of actively managed mutual funds not beat the market, they are going to charge us an arm and leg, and extract up to 2/3 of our potential nest egg in fees. But here is the kicker, they are going to have the nerve to look you in the eye and tell you that they truly have your best interests at heart while simultaneously lobbying Congress to make sure that is never the case.